start off the show as usual, just talking about kind of what we saw happening in the market. There's a lot going on,
Mhm.
as usual. There's been a lot to talk about. So let me switch over to the chart here. Okay, so really fascinating. Today the market's up, 1.5%, pretty good move.
Be 9 days in a row if it closes positive.
Yeah, 9 days, right? So that's a pretty big run. And so I'm getting some questions about, why we're not moving back in and what have you. So just to reiterate, we removed our equity or stock market, exposure for our clients. We went from 63% exposure that our average client had down to 23%. And again, some of our clients are at no exposure and some are at higher, but we left the stuff that had high capital gains. In my opinion, we haven't gotten to a position where we should be taking high capital gains. We took some gains, but nothing of any real substance. So that could change. We'll talk about some different things. This week we had a lot of things going on. Actually, we had the report that came out for inflation, which is important, the PCE, personal consumption. It was down at 2.6%, but for the quarter, it was 3.4%. And compared to the previous quarter, actually 3.5%, compared to the fourth quarter last year, it was 2.5% for that quarter. So, inflation is picking up, likely because of the tariffs and people are going out and pre-buying and what have
Yeah,
you.
a lot of people are trying to get ahead of the curve by buying stuff that's still in stock.
Yeah, and the gross domestic product report came out. It was negative, right, for the first time since 2022, negative 0.3. Although I think you can discount it quite heavily because the way the gross domestic product works is imports are a negative, and there were a huge jump in imports for the same reason. Everybody trying to build their inventories prior to the tariffs hitting. And so I think that's one of the big picture items that's happening. And just to understand, it's very, very fascinating. Lots of sales happened in the first quarter,
Mhm.
and some of it's pre-sale so that people built up their inventory. They may not be buying that much inventory in the future because they already have some. Consumers went out. We heard stories about Apple stores being crowded and, what have you, went out and bought things prior to the, tariffs hitting and what have you too. So, we've got all these pieces happening and whatnot, and it's really kind of it's sort of a mirage, right? I mean, we've got this, sales up. We've got retail sales were up tremendously in March, for example. Um, and so the real impact's going to probably come later. We'll talk about that here in a minute. But um, so again, we're in T-bills, ultra short-term bonds, treasury bonds. We still have our regular bond positions that we have in our normal, models and all those types of things. But we're down to actually a 22% exposure now
Mhm.
in the equity market. And so, we just had 9 days in a row. Why aren't we making a move to get back in, right?
And there's been economic data showing softness too.
Oh yeah. Yeah. It's coming. And so it's sort of like, you know, it starts at the ports, right? In China, you got 60% less shipping. Eventually we have less of those ships coming into our ports here. It hits the dock workers, it hits the truckers, right?
Mhm.
And then eventually you end up with shortages in retail, shelves that are empty in some cases. So probably less retail employees needed if there's less to sell, right? Um, but it really hits very early an area that's not being talked about, which is the small business. Maybe Target or Apple had the ability to go out and preload a huge amount of
Mhm.
inventory, but a lot of small businesses don't have that much capital to be able to do that. 80% of the people that work for a business here in America work for a small business, and 80% of the capital expenditures come from small businesses. We never talk about small businesses. We're always talking about
Yeah, because
Apple and what
the
have you.
small businesses don't really affect the S&P 500.
No, they don't. But they do affect the overall economy, which then affects the S&P
Mhm.
500. So that's where you're going to see the biggest impact coming in the fastest is because, these companies that happen to have their production done in China and they can't get it done anyplace else, they can't even afford the tariffs to reorder.
Mhm.
And so they're just not reordering. And they're going to run out of probably inventory sooner than others. Lots of stories about, it was a paper mill, a town of 22,800 people. The paper mill started in 1800s. They're closing down because of the tariffs, and it's going to be a big impact to this town. And there's toy companies. I mean, I've read dozens and dozens of stories about small businesses that are right on the edge right now. And so these tariffs are going to hit, and we're going to start to see then probably some higher unemployment. We did see first-time unemployment claims went to 241,000 this week, and so that was maybe one of the signs. Now, however, we also saw that today, new job creation went to 177,000,
Hmm.
right? The expectation was 138,000. So again, we're getting this kind of bifurcated, motion. Things are still, at least in hindsight, still growing, right? Matter of fact, the GDP, if you take out the, massive jump in imports, estimates were it was roughly around 2%, which is not a bad number for the quarter, as it turns out. So, you know, but we're looking forward here, and so the market's going up because there's you know so much pessimism in the market. When you get that, the reverse tends to happen
Hmm.
because everybody who's worried about the markets in the future, like we are already out, and that leaves the buyers to come back in. And then you have a pretty good amount of these quant programs move in the market in today's world. They don't care what's happening.
Hmm.
They don't even look at any data whatsoever. They just are because they're very fast traders, and they can take advantage of this. Uh, and so I'll show you a couple things to understand about some of these downturns, and so kind of from where we're coming from. So this is a chart. I think a good way of looking at it. So this was the 2007 to 2009 downturn. I call it the 2008 downturn. And if you look at that, there were 8 times that this thing rallied, right, between 7 and 24%, all the way to a negative 57. So just because it's coming up doesn't mean that it's going to be turning around tomorrow. Now, the one thing that is different about this is if tomorrow they got rid of all these tariffs,
Hmm.
I mean, unilaterally, not just the China one, which is the big one that has to be dealt with. And we are hearing, back and forth noise from both parties saying that some conversations are starting, which is good. Kind of wanted to see that this week. But the stories you read out of China is they're expecting this to last for the entirety of Trump's term. Was what I read today. So, but they want to see tariffs come down, to a more meaningful level than they were talking about 40 to 50%, which would still be anyway. Uh, so rallies happen in downturns, and we are in a primary direction downturn, right? By all the check boxes that I have. And so when the market goes up, when the primary direction is down, that's the minor move, not the major move. And so that's what you're seeing here in this 2008 downturn. Lots of minor moves, 11%, 7%, 12, 7, and 24%, right? So lots of, motion and things that are happening as far as that goes all the way down till we finally hit some bottom. Now let's take a look at a more recent time frame. This is 2022. All right, this just happened. We hit a peak, and then inflation hit. And at the end of 21, we started hearing about, from the Federal Reserve, November of 21. I remember even it was Thanksgiving that Friday. The Fed was uh, out there hammering the market with their comments about, what was going to happen with inflation and raising interest rates. And so you saw, I got arrows on two of the big rallies. Right over my head is the bottom. That's October 13th, 2022. So that's a 28% drop from high
Hmm.
to low. And we had the first arrow there, that's a 15% run up. The second arrow there is an 18% run up. So why why did those fail? I mean, what's the fundamental issue that was going on there that caused those to fail?
So we were during the 2022 was inflation and the Fed was raising rates.
Right.
And so these were speculative moves before the Fed actually starts paused rates or started to cut rates.
Right. Some hope that they might, that gets dashed by the Fed still coming out. I remember that period very specifically because the Fed actually wanted, in my opinion, the market to come down because that would help them with their inflation fight, right?
Hmm.
Because if you make people feel poorer, at least temporarily, they'll
We'll spend less.
spend less, right? And so, that big peak that at the 18%, there was that Jackson Hole meeting, and Powell came out very negative, and really just drove that whole market all the way down till October. And so that's the key here, right? So the when you look at 2022, you see those big run-ups and you think, okay, great, the market's coming back, but it didn't because the underlying issue was still there,
Hmm.
which was raising interest rates. Okay. The underlying issue for this is still here, right? So let's take a look. The Smoot-Hawley, okay, this was passed by Congress back when they used to do that in June 17th of 1930. So it was a 20% average tariff, but it was only on 25% of the imports that were coming in. They selected different things. It wasn't the broad-based thing like we had here. So the Trump tariffs right now are higher than that, 22.5 to 22.7, depending kind of what you're listening to. But these are much broader. Okay, so our average tariff will drop when they get rid of that 145% and get down to something more manageable tariff against China. And so that could bring our average tariff down below what was happening here in 1930. But when you look at the broadness of it, it actually is expected to be higher than what we had in 1930 because right now we have a 10% tariff basically on everything.
Hmm.
They've made some carve outs, right? So some of the pieces for automobiles were carved out this week. And the 10% is still, actually, I think Apple still is sitting on a 20% tariff for their stuff coming in from China. They were relieved of the 125% that was
Yeah.
added on, but still at 20, that wasn't there before. And, the 2018 tariffs were pretty small, 10% on certain items coming out of China. And that stopped. The Federal Reserve started lowering rates. The market came back pretty quickly. This is significantly bigger than that. Matter of fact, this is the biggest since 1909, where we're at right now. So if we look at, so that's my underlying thought process here is as long as this situation is in play, we have to be careful, right? Because here's the that's when it was passed, right there in the Great Depression, and it's credited with exaggerating that. And the idea behind it, if you go back and look and study this, they were at a little over 6% unemployment at the time.
Yeah, and the idea is with tariffs, you protect local industries, and then local industries will start producing, and then they will employ more people.
That's right. So they were trying to reduce unemployment from the 6%. So it seemed like a good idea, although there was a whole bunch of economists at that time, just like now, saying, hey, this isn't going to work because there's going to be retaliatory tariffs, which is exactly what happened. And unemployment went into double digits and stayed there for a really long time.
Mhm.
And the big bread lines you see and all that. And so even now they're talking about, yes, this will create some jobs, but there'll be more jobs in general lost in total. And so tariffs have the reputation, especially at the level that we're talking about now, of creating much higher unemployment, right? And so this was an 87% drop from high to low. In my opinion, you just can't sit there, unless you have high capital gains, because again, the tariffs could disappear. They could get rid of the 125% extra tariff on China next week. There are enough things that can be changed by stroke of a pen, so to speak, or just by Trump deciding on something else, that we could avoid all of this. Okay. But as long as it's there, you've got to assume it might stay. I mean, China might not come down, right? And well, so China's at 125% on the US. What if they don't come down? Is the US going to drop it down below 125? I mean, as a negotiating point, I probably wouldn't. That puts us in a position of weakness. So there's pieces where you can make an argument that this is going to be difficult to solve, and there's situations where you can make an argument that this will be over next week. It's possible. So someplace in between there is probably reality. And in the interim, we're already having some damage that will have an impact. But I do think if they rectified tariffs fast and reduce them dramatically from where they are now, I do think that would, whatever gap we have right now, 2 months, 3 months of suffering through shortages and maybe even some price increases because of those shortages, the market will look past that because it'll know, where the tariffs are. So there is a possibility here that the market goes, which is why you don't want to sell your highly capitalized, your highly capital gain stock, in my opinion. Um, so where do you go? Well, this is kind of interesting. We take away that weekly summary. There we go. This is this is risk level versus, the reward, risk versus reward. That's a pretty cool little chart. So if you start at the bottom, right, the least risk, okay, not much reward either, honestly, but better than nothing. Treasury bonds and T-bills. And that's mostly where we are with our assets that are not in the stock market. Uh, and then CDs are next, which is kind of interesting. CDs aren't as safe as a T-bill, for example,
Mhm.
uh, because it's just the general obligation of the bank. If the bank fails, then the FDIC steps in, but the FDIC isn't the Treasury. It's not a direct obligation. If you look at the Heritage Foundation, who wrote Project 2025, a lot of their stuff was talking about eliminating the FDIC. Now, they didn't put that directly into Project 2025. They talked more about reorganizing the FDIC and combining it with several other groups. And then it's a little vague as to what would happen with the insurance for the CD.
Mhm.
So that's why T-bills are the place to go for pure safety if you're just trying to ride out something big. And it just keeps going up: bonds, dividend stocks, cryptos at the top, penny stocks, and those types of things. So just that's where you kind of want to hide out, is in that T-bill arena. If you look back at the Great Depression or even 2022 or any of these time frames, the T-bill would have been a good winner in that time frame. Gold comes up quite often, and it's been a great diversifier so far. But when things really hit the fan, gold gets sold.
Mhm.
At least that's what we saw in 2008 downturn. It's a store of value, so people will sell it because they need that money, as far as that goes. So, anyway, that's our summary, for the week. Just trying to answer, why we're suffering in a way because we got out through a 9-day up run. But the underlying piece that is causing the downturn in the first place hasn't changed at all. There hasn't actually
Mhm.
been one single announced, negotiation that has been finalized. I know the rumors are that India is right there. Maybe that happens pretty soon. There's probably others, although I've heard Europe is really doing something similar to China. They're just kind of standing back. And so, that hasn't gone very quickly. Right. So, but there are some pieces that could be done, but there hasn't been anything done. And so you've
Mhm.
got to assume, you got to take where we are today and say, okay. And honestly, do we really think Trump would wipe out all these tariffs? Would he get tariffs down to a point that are below, on a net basis, where we were in 1930? I'm not sure. Certainly, he's not talking about that. It's not what he's saying. He might respond, as I talked about last week, to a falling treasury market, because that's a big deal, makes yields go up, which is exactly the opposite of what he's trying to accomplish. So, and that's why we got the pause. So it's possible. We'll see. But this is again, I look at this as playing, going to play soccer on a minefield. It might work out, but the risk doesn't, the reward doesn't outdo the risk in that particular
Mhm.
situation. That's kind of how I look at this market, even with this nice run up. Again, we had great run ups in 2008, great run ups in 2022, both of which had multiple failures in those run ups. So the only way this run up doesn't fail is if the underlying condition changes. You could go right back to an all-time high if you get that situation where, they eliminate the 125% tariff for China. I think that would probably be enough to really get it to go. The Federal Reserve cuts rates, although now they're talking about May 7th, next week they're meeting. But the job report came out. It was very good. So the Fed's not going to, I think the bet is 98% chance that they don't
Yeah,
change
they're
rates.
gonna sit on the sidelines for
Right.
a little bit longer.
And June went from a majority futures market believing rates would drop in June to now the majority is that they won't drop,
Mhm.
just from today's report. So the Fed isn't going to step in and kind of make that push that would help the stock market. it looks like, unless there's some other soft data that comes out. Unfortunately for the Fed, the strong data is still there because of all these purchases that have happened for people responding to the possibility of tariffs, both businesses and consumers. So I think it'll be a little while before we see the Fed step in because they won't really have the justification to do so as far as that goes. So anyway, that's the summary for this week. Kind of let you know where we're at and how things are working as far as that goes. I'm hoping for the best. I hope that this rally that we're on right now just keeps on going, that they get the tariffs under control, and allow the Federal Reserve to maybe start lowering rates again, and we can take off and go. But as far as we have to play with what we see right now, right? And so that's the issue.